Good afternoon, everyone. In today's video, I'd like to share a bearish trade setup inside of GOGO, and I'll try and keep this video fairly quick. Now, the first reason that I think GOGO looks interesting from a bearish standpoint is if you draw a trend line using our previous high, then the second lower high, you draw that line and you extend it out. We're currently hitting the upper bound of that trend line. So that's bearish reason number one, hitting the trend line right here. Now, bearish reason number two is the fact that while we're hitting that, we're also in overextended territory dictated by the 3-period Keltner channels. The way that's being calculated is the extended Keltner Channels indicator. This is a free indicator set to a KC factor of 3.0, which is signaling to us that we're officially in overbought territory. So that's bearish reason number two. Now, in terms of bearish reason number three, that's the open gap right down here below, also supported with a squeeze that is fired. We're 2 dots into a fired squeeze, which is where we would start to expect to see momentum at least dry out a little bit. And if we have aggressive and conservative zones here, the aggressive would be really the upper edge of the market pulse line. So we'll pull back to the market pulse. That's right around $12. So let's call that the upper edge of our zone right here. And then our lower zone, in my opinion, would be where we get a gap fill. That's near the $10 mark. So you have this $10 to $12 range in which we'd like to try and build some position here. And it would be nice if we could do so using options where we have a defined risk. So let's head into our trade tab to try and build some potential positions. So now inside of our trade tab, the first option that you have is coming inside of that 100 days to expiration series. Do something like a $12 and a $10 put vertical debit spread. That's going for a 75-cent debit. So you're risking 75 bucks to try and make a potential of 125. And that's one way in which you can skew the risk reward in your favor. Now, if you were trying to be really quote unquote adventurous, you could come out and do something like the $10, which would be a gap fill only, and then sell the 9 against it. And if you did something like that, the $10 and the $9 vertical, that's risking 25 to try and make 75. But again, you need a gap fill all the way down to even slightly below the $10 mark actually in order to make any money on this position. So that's where I think the 12 and the $10 wide, where you have a break even somewhere in between the market pulse along with that $11 mark, makes a little bit more sense. Now, one other kind of out there idea, which I think is interesting from the volatility perspective, is if you come into the Jan 2023 series, and then you also open up something like, say, either the 37 or the 100-day series, and you focus on that $12 price point. So for the further dated option series, you buy that $12 strike. So that's currently going for 340, 330, 340. Now we come in, let's take a look at the premium for selling the $12 strike near dated options. If you came out to 37 days, you would collect anywhere between $50 to $60 for that. So that would essentially be turning this $12 call into your real estate property that's generating for you 50 or 60 bucks, anywhere between there for 37 days. And that would be one potential option. If you gave it 100 days, you'll see that goes up all the way to 125 to 135, which may be a little bit more lucrative. Seeing that, you would have 527 days to try and repeat a similar position more than 3 times to then have this put essentially paid for. So the way that would look is buying that $12, coming into that 100 days to expiration series and selling the $12 put against it. That reduces your debit all the way down to $1.95 if you can get that fill. If we analyze this trade here, and I bring this a little further out. So we make the most money if we have the pin at $12, and that's inside of that 100-day period. So that would be 19 November. So if we did have that downfall, that would be the greatest if we pin at 12 bucks. If we overshoot that, no problem. We have a nice cushion all the way down to right around that $10 mark. If we really overshoot that, this position does start to go negative, but your max loss is the debit we've paid, 195. Same way, if we overshoot this on the upper side, you have a similar locked-in debit there where you have a little bit more flexibility along with time to try and manage this position and do something creative to try and at least have this option pay for itself. So just by simply buying the 2023 options, selling the 2021 but 100 days out options, you're able to reduce the debit of that put option down to 195, or if this does expire worthless, you've instantly almost halved the cost of that option for some position that took only 100 days in this overall 500-day journey. All right, so I hope that video helps to give you a trade idea to play this downside move inside of GOGO. If it does pan out, there's reasons why I think it will pan out, but of course this trade idea is a bust, especially if we break above this previous high That would then take us into new territories where we'd be looking for a break above even 17.23, turning this from a bearish setup into more of a breakout setup. Alright, I hope this video was helpful. Take care everyone, good luck trading, and we'll see you in the next update.